Many bankers have been asking me what happens to bank-owned life insurance yields if interest rates go up, particularly as they're looking at their economic value of equity calculations, their EVE calculations. So to help answer that, let's take a look at a graph here. We've got duration here on the bottom and interest rates on the top. If we look at a 5-year treasury yield, you're going to be right around the mid ones. If you look at bank-owned life insurance, it's somewhere between 3 and 3.25. So there's clearly an advantage to bank-owned life insurance over the current securities market that's out there. Now, to take a look at how would bank-owned life insurance reprice compared to your 5-year treasury if there was a change in the marketplace, we're going to use an extreme example from December of 1980 when Chairman Volcker raised short-term interest rates substantially. So let's just say that happens 2 years from now, and they go all the way up to 7% from the current 1.5%, and then just for graph purposes, that's the new sustained rate. Now, if you were a very smart banker or extremely lucky, you would have gotten out right here and gotten back in right there. But the reality is you're going to be holding a portfolio that's going to be repricing as you go. So if you look at this graph, this is the area of gain with the bank-owned life insurance over and above the yield from a 5-year treasury. Up here, however, would be your area of risk if we had that much of a shock up in value in that short amount of time. Reality is, though, bank-owned life insurance does reprice. Will it reprice overnight? No, but it will reprice on a very smooth and linear fashion, much like that line, which would eliminate a lot of the red that you're going to have with a potential bump up in rates. But to be fair, we need to put this into a tax equivalency because this is taxable, this is not. So a federal tax equivalent with a bank-owned life insurance, you're really looking at this level of gain over and above a current treasury, which means your repricing line will look more like that. So because of the tax advantage that BOLI has, you really see very little lag and mostly all gain. So your area of lag is now just going to be in this little area here, and that's only for a year or two if we have that dramatic of a shift. The reality is we're not going to have that dramatic of a shift given the level of debt that our nation has right now, because with closing in on $20 trillion of debt, the interest on that, if it goes up too fast, we just won't even have the tax money to pay it. So best guess is the Fed will raise rates 0.25%, maybe 0.5%. And if that happens, because life insurance reprices either quarterly or annually, you'll never even see a lag because this is a worst case scenario. And going forward, you'll be in great shape. The beauty of bank-owned life insurance is you can shock it up and down 200 to 300 basis points and you'll have no noticeable effect. And you're shifting your price risk, your market risk, and your credit risk over to the insurance carrier and off of your balance sheet.